I'm going to explain why iron condors are a goldmine of an opportunity and how you can make monthly consistent income and grow a small or medium portfolio fast using my specific iron condor strategy in this video. How I open, close, manage, and profit with a lot of detail in between. Listen up, because this is easy money if you finish this video, and I guarantee you it's the best one on YouTube on iron condors. And if you understand what I'm going to tell you, you are going to make money. And if you don't listen to my last management strategy, you are definitely going to have lower profits in this trading strategy. All right, here's Netflix. Netflix is a very interesting setup right now. And if you're watching this in the future, it doesn't really matter. You just have to understand where the stock is currently trading in relation to its history. So look at this Bollinger Band right here. I love Bollinger Bands because it gives me a very good sense of where the stock is likely to trade within based on statistics. Now, Netflix is somewhere in between its Bollinger Band, which makes it the perfect setup right now for an iron condor. Because you see, if it was at the top of its range, that would make it pretty expensive. Now, if it was at the very bottom, like right here, then that could be a signal that this stock is oversold and it might rise. But currently right now it's sitting right in between, which is a very strong signal and a very strong setup, because if a stock has already kind of fallen down from its peak, but it doesn't look like the momentum is going down, that makes it a very good candidate for an iron condor, since an iron condor benefits if the stock continues to move sideways. And something like Netflix right now is moving sideways. You don't have to use Netflix, you can find a different stock. As long as it's going sideways, the iron condor strategy is the best one that you can implement. Choosing the correct strike prices and expiration dates is vital to ensure that the trade has a high probability of success. Properly executing the opening leg sets the foundation for potential profits and it minimizes risk. A lot of people ask me, how do I manage this position correctly? Well, the most important thing that you can do for managing the position correctly is opening the position properly to begin with. If you open an iron condor properly, you have done 90% of the work required. When executed with a disciplined and a precise strategy, the iron condor strategy can provide traders with a reliable stream of monthly income. So let's open this up in my Robinhood portfolio right now, which I do have a link for in the description if you want level 3 access. Now, taking a look at Netflix, trade Netflix options, okay? What I'm going to do is I'm going to pick an expiration out into the future. Now check out the chart. I am using the Bollinger Band and it's going out about 20 days. Not about, exactly 20 days. So what I want to do is actually, this is 20 trading days. So I'm going to go out roughly about a month. So that would be August 25th. Again, if you're watching this in the future, it doesn't really matter. You usually want to go out roughly 1 month. You can do weekly option trading and iron condors are a suitable strategy for that. However, for me, I like monthly trading because it's less work, it's less management, and if I open up a good position, I can set it and forget it and just have a monthly profit. Now, how will I pick my strike prices? Because this is the most important thing that you can really do. If you pick the correct strike prices, then you don't have a lot to worry about. Even the stock bounces up and down, most likely your iron condor is going to be very profitable. So for example, check out the bottom of the Bollinger Band here is roughly 400 and the top is 482. Now that's very wide, but the good news is that Netflix has a lot of implied volatility. So if I go down and I go to sell put option, and that's how you want to start off an iron condor, you want to get started with the puts, you can see here that the $400 strike price right here is still a 21 delta, so not low. And the reason why this delta is not super low, and we'll talk about delta in just a minute, is because the implied volatility here is pretty good. I mean, it's pretty big. 33%, almost 34% is not low. It's not super high, but this is a very good amount of implied volatility. And this is actually going to give you really good premium. So for example, if I go ahead and sell the $400 put option here, now my typical iron condor here is going to be a $5 gap, meaning if I sell 400, I do 395 on the buy. If I sell 390, I do 385 on the buy. Okay. So I like to have a $500 spread. Now you can do $300. You can also do more than that. I just like $500 for many reasons. If you have any questions or preferences yourself for the strikes that you pick, let me know in the comment section below and I will answer. So I have sold the 400. Now I'm going to go ahead and buy the 395. So if I go ahead and buy the 395, this is a put credit spread. Now to actually make an iron condor, I'm going to have to also sell call options, right? I'm going to have to scroll up, and the top of the Bollinger Band, I'll remind you, was around 482. So to be extra safe, I'm going to go ahead and sell the 485 right here, Now you will notice that the delta is going to be lower, and yes, it is lower. I already knew that because I could look at the premium and see that the premium was a lot lower than what we collected here, which was $500. Now we're only collecting $247, which is fine. That is what it is. It's basically based on the Bollinger Band here, okay? So 485, I'm going to sell that. I'm going to go ahead and buy the 490. And now this is an iron condor. This is actually a short iron condor, and the benefit of a short iron condor is that the stock continues to move sideways. And again, reminding you that Netflix is likely to move sideways based on the technical analysis that I have done my work on. So right here you can see that you are risking about $350, but again, if it stays in between here, you will be successful in collecting and making $150 per month with just $350. Now look, management is the secret sauce, because you really need to listen to this. It's really easy money if you understand how to manage this position. And I really do look at delta. For example, a high delta is not really good, especially if you're doing a selling strategy. So this is a selling strategy. You know that because we have sold the 485, which is the closer to the money option. What I mean by closer to the money is we're at 427, 485 is closer than 490. So this is a selling strategy because I am betting that Netflix won't rise above 485, right? So my goal is it doesn't go above 485 because that's where I will start to lose money and potentially go into this red zone. Now on the put side, I wanted to not fall below 400. And again, I don't think that is likely. I think Netflix will trade within this range. Okay, but if it falls below 400, then I will start to lose money. For me, I'm always looking for a delta of 0.2 or less. The lower delta you go, the safer this iron condor will be. But of course, if you pick a delta that's super low, like 0.03, 0.05, then it's going to be very safe, but then at the same time, your premium collected will also be very low. So you want to have a very healthy balance of making really good money, but make it consistent. And that's exactly why I pay a lot of attention to how I open an iron condor to begin with. And the iron condor is the fastest way to grow your portfolio because it has both sides. You're selling both the puts and the calls. As long as you get your entry correct, then you are going to be very profitable. And specifically, this is what I focus on in my smaller Discord. I have 2 Discords, and on the smaller Discord, I really focus on spreads. You can actually get a deal for the smaller Discord if you get my book in the description. After you get the book, you actually have a special promotion for the smaller Discord if you want to try it out. Now, speaking about profits in the iron condor strategy come from a combination of time decay and a decrease in implied volatility. So I was just showing you that this option right here had an implied volatility of roughly 35. Now, the higher the implied volatility, the better because the premium is higher. And if you're selling options, high premium is a good thing because that's what you pocket right away as soon as you open up this iron condor. For example, as soon as I open up this trade right here, I will collect $150 immediately into my portfolio. As the options contracts lose value over time, the trader benefits, and if the implied volatility drops, the option premium also declines, leading to more profits. So over time, this option position will decay. You can always buy it back for a profit. However, for me, I like to hold until expiration. Leaving an iron condor alone after opening can be a beneficial strategy. And for me, it's very beneficial for several reasons, primarily related to the strategy's design and, well, the expected outcome under certain market conditions. So the market condition that I want to happen is that the stock continues to move sideways, okay? If the market continues to move sideways, then basically theta right here will continue to kick in and give you more value. So for example, this theta right here is 0.13, meaning about $13 per day. Now, of course, you have some other options here. If I go to the 485, you will see that the theta right here is 0.15. So you're making $15.45 per day. But of course, this one right here is working against you. So if you take the difference of the 15 and the 13, it's about $2 a day, okay, on this side, and probably another, $2 or $3 on this side. So it's basically $5 a day, but the reason why it seems so small is because this option is expiring in 30 days. As it approaches expiration, today, let's say you make $5, tomorrow 6, 7, 8, and it continues to go up until the last day, you may make, $25, $30 in the last day. So it is really beneficial to hold this option until the very last day because that's where the most theta really is. The most theta is on the last, few days of the positions. Now, in an up market, it may challenge your call side, okay? What you will do is if it hits the call side, in some cases you can roll higher, close it out. But in most cases for me, I decide to do less work. I decide to make it a more passive strategy, and I leave the position alone until expiration. Now, in a sideways market, you definitely leave the position alone because it's just going to be decaying very easy. It's not even going to test any of your limits. It's not even going to get close to your call side or your put side. So that's a very easy market to work with when it's slightly up, slightly down, or sideways. Now, in a very down market, it's also dangerous for your put side, right? Because if it goes below 400, just to remind you right here, if it goes below 400, well, you are in trouble and you can lose the total $350 that you have at risk. And in most cases, if it goes right here and there's still some time left, I will almost always close this position. So for example, if it goes to like 379, it's clearly in the money, there's a few days left, and I can salvage maybe a loss of 250, I will lose 250 rather than 350, especially if it's very clear to me that it's in this red area. So if it's in the red area and it's a down market, then I am going to close this position. It only makes sense to do that. Obviously, I'm not going to hold a losing position that's obviously going to lose and go further against me if I can just close it out now and not lose the full amount that I risk. Here's some reasons why it's really advantageous to let the iron condor run without constant intervention, because most people, most of my students, they want to do more. They're doctors, they're lawyers, they're business owners, maybe truck drivers, software engineers, right? They're used to putting in the hard work, and they think that they need to put in more work to get better results. But actually, the furthest could be from the truth, because the first thing is time decay. Iron condors are designed to benefit from time decay. As time passes and the options contracts move closer to their expiration dates, the value of the option tends to decrease. By leaving the iron condor untouched, I mean really, like don't touch it, you allow time decay to work in your favor, potentially leading to a profitable outcome, right? If you don't touch it. Now, number two is implied volatility. Iron condors thrive in low to moderate volatility environments. Now, if there's high implied volatility and you sell an iron condor and then you wait for it to become low and moderate, that's even better. But you can still sell iron condors in moderate volatility environments. When implied volatility decreases, the option premiums also tend to decrease, leading to potential profits. If the market remains relatively calm, the iron condor can reach its maximum profit potential without any adjustments, and you're going to see some pretty big gains in the short term, and in some cases you can close. But in most cases, if there's like 10 to 15 more dollars to be made and there's only a few days left, then I would just leave the position to expire worthless. Now, there's also benefits to letting it kind of ride by itself because there's reduced transaction fees. So constantly adjusting an iron condor will obviously result in, increased transaction costs, which I really don't want that to happen. I always tell my students, if you leave the position alone and you just do monthly trading, you are going to be saving potentially thousands of dollars in transaction costs. And honestly, it does minimize not only the cost, but it also improves your risk to reward ratio, because a lot of people get really emotional, you really want to avoid emotional decision making, because frequently intervening and looking at your portfolio in a trade can lead to emotional decision making, especially if the market experiences short-term fluctuations. Emotions like fear and greed, they're going to influence traders to make impulsive adjustments that can negatively impact the overall performance of the iron condor. So a lot of my work in the Discord is, because you have access to me 9 to 5 every single day, is honestly financial and emotional management, right? Kind of like a financial therapist, because I want to make sure that people don't overtrade and don't make errors that they shouldn't be making. So staying committed to the strategy, the iron condor strategy, is based on, specific thesis that you have, that the market is going to be range bound. That is your expectation. And by leaving the trade alone, you remain committed to your initial analysis and give the strategy time to play out according to its design. So by entering in the strategy properly, that's where you have the most chance to be successful. And after working at Goldman Sachs, I noticed that iron condors weren't used too much. And that's because when they do go wrong, it's additional work to close out the trade, since they have multiple legs open. My formula is to open no more than 10% of an account total value in the iron condor strategy. Before Amazon actually split in 2021, I had a very profitable iron condor, as well as on Facebook, making 50% in a short amount of time. Although old, if you're smart, you will pay attention to these two examples, because that's the exact big contributor that I had to my portfolio when I grew it from $100,000 to $700,000 in 1 year. So pay attention to these two examples right now. All right, guys, we're going to be taking a look at my screen right now. I'm going to be showing you a real life example of an iron condor on Amazon. Now, I had a heavy debate between using Amazon, Apple, or a different stock, but I chose Amazon because it's actually very interesting to play iron condors. since Amazon is such an expensive stock, it's very difficult to really do any put selling on Amazon or any covered calls because you would need a whole lot of capital. So instead, there are other strategies that we can use without requiring so much capital, and that is an iron condor. So I'm gonna walk you through an exact example of what I would do. Now, I do want you guys to understand that it is after hours right now, so the market is not open. I'm just going to show you a hypothetical example of what I would do if the market was open, but don't worry because you can use this type of strategy, and I'm gonna explain my full logic, my thought process, and how I think about option trading, especially in terms of an iron condor, so you can pretty much copy, mimic the same thought process, the same logic, and use it on a different stock. So it doesn't have to be Amazon. It can be any stock that you choose that you think is going to stay somewhat range bound, that's not going to explode higher. So what that means is it's very important that you do iron condors on stocks during time periods when they don't have earnings, because of course an earnings event could really shoot up a stock either upwards or downwards, which would hurt an iron condor position. So with that being said, let's go over this example with Amazon. So I'm going to go out a little bit in terms of time. Right now it is July 7th, and it is not going to be appropriate to do July 9th. That gives us absolutely no time to work with. And since an iron condor does have 4 positions, I do like to go out just a little bit farther. So I do like to teach students to do weekly option income strategies. However, what I'm going to do is with iron condors, the returns are so big, they can be over 10, 20, even 30% in a single month. I'm actually going to go out about 1 month. I would pick August 6th, but something that you guys might not know is that options historically actually expire the 3rd Friday of every single month. So without going through too much time and wasting time here, I'm not going to pick August 6th because I already know that Amazon is going to have options for August 6th, but they're not going to be as high volume. They're not going to have as good of a liquidity for August 6th. So I'm going to go for August 20. And by the way, just to prove my point, you don't see September 9th or September 8th. You see September 17th, which is the 3rd Friday of September. Same thing for October, same thing for November, December, January. This is a very specific reason that happens. I don't know the history itself, but when I was working on Wall Street, an option trader told me that. So instead of going for August 6th, I know it's not gonna have the best liquidity. We are going to click August 20th, guys. And I just wanna say, stick with me if it doesn't make complete sense. After I pick all 4 different options to create the iron condor, I will have a visual for you guys on the side here in Robinhood. That's a new feature that they have. So I will explain to you a visual feature. So do not worry if you don't fully understand, first of all. Okay, so the first thing to do when opening up an iron condor is we're going to be having 4 different legs. So what happens is you sell a put option, okay? So for example, we're gonna be selling a put option. I'm just gonna go step by step with you guys, okay? Step by step and give you an exact explanation. So currently, the stock price is at $3,696. Okay, so what I'm going to do is I'm actually going to open up an iron condor for about $500. We're gonna see it might be 1,000. I have to do some analysis on what is the best option here, but it's probably going to be $500 worth of risk, and we're probably going to collect a whole bunch of money. It's probably gonna be around 25% return, but that is my prediction. So let me actually do the actual picking of options. So the reason why I'm going down is because, well, first of all, we're opening up a put credit spread, and I'm going to make a whole video on put credit spreads very soon. Basically, the first thing we have to do is we have to sell a put and buy a put. Sell a put and buy a put. That's how we get started on one leg of the option, okay? So we're going to pick a put that is far out of the money. And the reason why I'm picking a put that is far out of the money is I want as little risk as possible. I do not want to get executed on the iron condor. I don't want it to go into the red territory, and I will show you exactly where the red territory is in a couple of minutes. So first thing I'm going to do is I'm going to pick, let's say, the 34.50 strike, and that is going to have a 24 delta. That is good because that's a fairly low delta. So here we go. I'm going to sell this put, and there we go. So now what I'm going to do, and this is very important, guys, you have to do the opposite. Now you have to buy a put that is going to be a little lower. And the reason why you do that is if you sell a put, you have a whole bunch of risk. But now if you buy a put, no matter what happens to Amazon, if Amazon goes to 0, that would totally be fine because now you are kind of covering your butt. Now you have an exit. If this option goes against you, this option will go in your favor, and it's going to close off the potential downside of $3,450 with this $3,445, And the difference, guys, is just it's $5, or in option terms, it's $500 because each option is 100 shares. So this is a $500 worth of risk, okay, guys? And because this option is closer to the money and this option is farther from the money, this option has more premium and this option has less premium. So you're selling the option that has more premium and you're buying the option that has less premium, guys. So look, now I completely closed off the trade. Now we only have a $500 worth of risk, okay? You only need $500 here. And check that out, guys. You're actually collecting $113, which may not seem like a lot, but your maximum loss is only $387. The reason why it's only $387, it's really $500, but because you're collecting $113, in actual reality, your maximum loss is only $387, which makes it even juicier than $500. So if you were to take $113 divided by 500, I'm just giving you guys the percentage return. If you double 113, that's 226, so 22.6% return. That is a 22.6% return, guys, in what is it, about 6 weeks or so. So 22.6% return is one leg. By the way, guys, we're about to sell a second leg, so we're about to collect more premium. But just from the put side of things, we are collecting $113 and our maximum loss is $387. So far, if you actually do the math, 113 divided by 387, we're gonna be around a 30% return. So this is going to be a very high return trade in 6 weeks, guys, very high. So the break even is 34.48, and the reason why it's saying 34.48 is because you guys won't lose any money at expiration until, better yet, if Amazon goes down to 34.48, because, well, unless it really touches this option, we're good. It really doesn't matter. As long as Amazon stays above 34.50, we're fine. And that's why I picked 34.50, because it is significantly below 36.96. So 34.50 is significantly below, so we're pretty safe here, okay? And the break even is basically 34.50. It's saying 34.48 because we do collect some premium, and because we collect some premium, we actually reduce the break even point just a little bit from 3,500 to 34.48. So that is one side of the equation, guys, and this is going to make a lot more sense when I open up the second leg of the Iron Condor, because this chart right here, it's going to change, it's going to look different, and I'm going to explain to you guys basically how it works, how this Iron Condor behaves during the whole process from opening it all the way to expiration. So now what we're going to do is I'm going to scroll back up to a higher price than what Amazon currently is, because this second leg, essentially, the first leg that we opened was a put credit spread. We sold a put, we bought a put. Now what we're going to do, guys, is very similar. We're going to sell a call and buy a call. Sell a call and buy a call. And the first call that we sell, that first call is going to be closer to the money because it's going to be a little bit more expensive, going to be a little bit more cash in your pocket. And then we're going to buy a call that's a little bit farther out of the money. Again, it's going to be $500. And because we're buying a call, we're protecting ourselves, we're closing off that trade, because if you sell a call, it's unlimited risk. But if you sell a call and then buy a call just a little bit higher, for that $500, we close off that risk. You don't have unlimited risk anymore. Now we have $500 worth of risk again. However, it gets very, very interesting, because when you do an Iron Condor, guys, only one side of the leg can happen. Only the put side of things can happen, or the call side of things can happen. Think about it. Amazon can't end up hurting you on both sides at expiration. It's either going to be somewhere in between, which is very, very, very likely, or it's going to end up below or above. Therefore, even though we are risking another $500, your account will not be another $500 will not come out of your account, basically. It's going to be a total trade of 500. Even though the put side of things is 500, the call side of things is 500, only one can happen. So you're still only risking 500. So although this says 387 max loss, it's gonna get better, guys. It's gonna get way, way better. And you guys are going to be astounded when you see what happens. So let's go into sell call. All right, guys, so for this second part, I'm going to show you how to open up a second leg, and that's going to be by selling the call option and then a further out call option. However, guys, I have a little bit of a tragedy here. I put in so much work into this video, but I realized that with Amazon, it doesn't have any $5 spreads anymore for the call option side of things, because it now becomes $50 spreads. So it's not going to be a perfect example. Unfortunately, Amazon is such a large stock in terms of its price that $500 spreads are just too little. Actually, most investors are going to need to risk maybe $1,000 or even $5,000. So this strategy is fantastic for stocks that are between $100 to $200. And actually, I'm gonna show you guys a trade on Facebook real quick. So I'm actually gonna show you the full Iron Condor on Facebook, but this time it's gonna be a little bit different, but you know, I do apologize. I'm gonna do the same thing. I'm just gonna show you guys an example. So we're gonna sell a put just like we did before. Now we're gonna buy a put just like we did before. Here, the trade is 125 and the risk is 375. Very, very, very similar to Amazon. However, this time we're going to have more luck with Facebook because Facebook is a stock between the $20 to $800 range. So yes, we have options that look good. Thank you so much, because I put in a lot of work to educate you guys and I thought that this video was gonna just go to the trash. So no, we're going to sell, you know, for example, the 425. Now we're going to buy the 420. What you guys will notice here is that we actually have collected more premium and now our max loss has gone down. And that's because we're selling both sides of the Iron Condor, or essentially the put credit spread and the call credit spread. So now we have collected an extra $13 here for Facebook on the 425, 430. 425, 430 is way, way, way far away from the current price. And actually we can probably dial in the risk more and have a higher return if we go closer to 400. So let's say we sell the 400 instead and we buy the 405. And again, we're closing off our risk from 400 to 405. We only have $500 worth of risk. Take a look at that, guys. We now collect $164 and we're only risking 336. So basically we have a 50% profit because half of 336 is right around the 168. It's right around 168 or 163. So we have an exactly 50% return, guys, up until August 20. So in 6 weeks, you can make 50% return as long as Facebook stays within this range right here. So basically, if it stays between the range of our break even of 325 on the downside, again, we sold 325. So at 325, we start to lose money because one side of the leg starts to go into the red. This is what I mean by the red. You can lose up to $336. On the call side of things, again, our break even is around $401. And the reason for that is because, well, you know, we start losing money around 400, but because we collected $164, our real break even for this Iron Condor will be right around $401.64. So as long as Facebook stays between this range, right now it's $350. As long as it stays between, you know, 325-ish to 401, you have a profit on your hands, and that is very likely to happen. As long as Facebook is trading within this range right here in the green, you're going to be in the green. And most of the time, this is a very successful trade because both times when this option would start to lose money is when Facebook would have a very fast and adverse move to the downside or a very fast momentum move to the upside. So as long as we're in this range, this is exactly where you want to be. This is when your Iron Condor will be profitable. Very important final details about Iron Condors before you try them. The logic behind employing the Iron Condor option strategy is to capitalize on theta decay while expressing a neutral outlook on the underlying stock. You don't have to be completely neutral on the stock. However, you want to make sure that the stock doesn't have any big earnings events or doesn't have any big events coming up, so the stock doesn't run up 20% on you or it doesn't crash 20% on you. Theta decay for Iron Condors is highly favorable. Typically, one side of the Iron Condor will depreciate much faster than the other side due to changes in the price of the underlying asset. When one side depreciates to the point where it's worth less than $5 to buy back, I will often buy back one side and I will open up a similar position so I can collect more premium. If you want to understand the Iron Condor on a deeper level, you should also understand my spreads video that you can check out right here.